A fifth of all venture capital dollars raised comes from university endowments. That's according to Forbes. And it is a figure that could get slashed as pressure from the White House towards certain colleges grows and their tax exemptions, for example, as well. Kate Rooney's here. She's got more on this developing story. Kate.
David, so universities do play a crucial role for venture capital investors. Endowments, they're a main source of funding for VC firms, which in turn go out and then invest in startups. And pressure from Washington, as you mentioned, could really throw a wrench in all of that. The recent House bill looks to take what was a 1.4% tax on investment income. That would go up to 21%, at least for universities with endowments over $2 million per student. So that mostly targets elite schools. Think of Harvard and Yale, for example. Historically, these colleges have plowed billions into venture capital and private equity, for that matter. Harvard's $53 billion fund allocates almost half to venture, and then Yale is just below that. Stanford puts in roughly 59% into venture. For University of California's $179 billion fund, about a third is committed to venture. And then for Texas, they've got a $63 billion roughly endowment. About a quarter is going to venture. That is all according to PitchBook. It's not just the new tax liabilities for universities. There's a lot of other pressure. Threats, for example, to pull their tax-exempt status, and then federal funding. Tech investors on the West Coast especially are worrying about all of these new financial pressures and changes to endowments' risk appetite, what they are willing to allocate as well to some of these less liquid private investments. And they might not ditch venture altogether. Folks I'm talking to say it could result in endowments looking for more tax-efficient strategies, lower-cost strategies out there. Think public equities, maybe ETFs, or muni bonds even, just sort of the more boring, less risky investment strategies, guys.
Yeah, well, Kate, they're facing a lot of pressure, certainly, as you say, at Harvard and a number of other universities, whether it's cuts in funding, the risk of the tax exemption going away or taxes going up. I mean, it's not just not funding as much venture capital, but there are actually continuation funds and what we call secondary funds that will buy their investments as well. I mean, I would assume that's growing because they need to potentially monetize so they can pay for things that they didn't think they need to pay for, given shortfalls, I guess, in their overall budgets.
It's a great point, David. I think the secondary markets could be some sort of silver lining for endowments if they say, I've got to get out of this tech investment, and I need to do that on a 2-year horizon versus the typical decade time horizon you're looking at. Typically, if you're in one of these funds, those secondary markets have gotten so much more liquid, especially as the IPO window doesn't seem to be open. As these AI companies the valuations are topping a lot of public companies out there. So that is something I'm hearing a lot from tech investors that say, all right, well, maybe they're not going to ditch venture altogether, but if they do have these increased prices going up, if they need to all of a sudden come up with cash, that could be where they turn to try to sell in these secondary markets.
It's an important story, Kate. Thank you, Kate Rooney.